All right. It is a real pleasure to have our guest speaker today, Teymour Farman. I met Teymour about 4 years ago when he was talking about the idea that he had, and as an advisor and consultant, I was pretty impressed with his vision. And it's quite impressive to see that he has realized the vision, and he's got more to share today. So we're really excited to have Teymour joining us. The title of our topic today is Bridging Borders: How Stablecoins Are Powering the Next Wave of Global Payments. And for a bit of background on Teymour, he spent he's a graduate of Harvard University. He spent some time at Google, a number of years there. Then he did substantial work at Zynga, as well as a few other companies, including Spotify and Zapple. It's really a privilege and a pleasure to have you joining us today, Teymour. So welcome on board. Before we jump into the subject matter, just real quick, want to give a general overview of who ConexAmericas is. And I want to thank those of you who are attending live, as well as those of you that will be attending later on the LinkedIn video that will be online, as well as on our YouTube channel. Daniel Chatelain, based out of Palo Alto, and myself are the co-founders of the group. We have a number of advisors in our group, including Gerardo Bonilla from DOC in Mexico, Carol Grunberg from Juno, Patrice Prayet, a fellow consultant and advisor based out of San Francisco, and Victor Unda, the CEO of Oki, based out of Guatemala and Miami. So just a bit of background on the organization, if we move on to the next slide. So these are the core objectives. We really focused on bringing Latin America and the US into one room. And we've been bringing a number of sessions that have featured founders, investors, as well as key topic experts to talk about their insights and their understanding. We'll be focusing primarily on the top three objectives here: regional market opportunity insights, providing access to expertise and insights, and then talking a bit about venture capital and funding. As we grow, we're planning to focus more on the last three objectives in that list. But that's just a quick snapshot on who we intend to be and what are the areas of focus. We'll be covering this last slide at the end of the presentation. So with this, I want to go ahead and get started with Teymour, who will be sharing with us, first of all, the journey of HiGlobe, just an impressive company he has built over the years. He was quite on the spotlight last week at an event in Mexico City that featured what's happening on stable coins in the Americas and Mexico primarily. It's an event that they had for the first time. Over 2,000 people attended it. And I also had a chance to talk to him at StableCon in New York a couple of months ago. There were a couple of thousand people there as well. Well, guess what? The prediction that I made 2 years ago that stable coins were going to be pervasive has happened, and it's growing very quickly, much beyond what I expected. Teymour is going to share with us some insights on that. So with that, thank you, Teymour and Daniel. Thank you for joining. So we'll go ahead and get started with your overview.
Perfect. Thank you so much for that warm introduction. What I am going to do is share my screen. I just want to make sure I get this done right. You can see my Chrome and okay, so you should be able to see the cover slide of my deck, right? ConexAmericas HiGlobe.
Yep.
So before I continue, I just want to give a shout out to Daniel, and Patrice Perret. I remember meeting Patrice Perret in 2020 when I was trying to figure out what to do. And he introduced me to Danny, and then to the other Danny Ayala, and then to most recently Danny Chatelain. But it was absolutely a true statement that Patrice and Danny Ayala in the early days were two of the most informed people in this arena that I'd ever met as a relative newcomer to the arena. So I'm very, very grateful to be here because a lot of what you see here has been informed by my interactions with Danny and Patrice. So without saying any more, let me jump in. Um, so I'm going to talk. It's a very simple deck. We're going to talk about how money was moved traditionally, like, and then what is stablecoin, or and why is it relevant to us? Why does it update our world? Then we're going to talk about something called the stablecoin sandwich, and then we're going to talk about the pretty seismic implications of zero marginal costs, because you will quickly find out, if you don't know already, that stablecoins cost nothing to move around. And we'll talk about that. And there's some real important implications and industry disruptions that hopefully might be, you might become aware of, that might be helpful as you go about your day-to-day business. So let's start at the top. Real easy. Everyone knows how money moved traditionally. Traditionally, you had Swift. It's a Belgian company that's majority owned by the United States and UK. You got the mega banks that own big chunks of Swift. Swift is a messaging network that moves money from bank to bank to bank. And along the way, the banks keep a little overnight fees, and that's why it takes 3 to 5 days, often more, to send money to Europe, the world's largest corridor. And what's stunning about it is your money will stop if one of the banks along the way has one issue or has a telecommunications issue and did not get your KYC information. Your stoppage is almost certain. So that is the way money works. It's an excellent system from the last century, but 90% of the world's money moves on Swift. Not 90, actually, probably near 70%, 80%, 70%. 30% sits in this form of money movement. This is called netting. So basically what happens is, this is a really simple concept. I can set up, PayPal can set up a bank account in 50 different countries. And in each of those countries, the local bank puts, $100 or $1,000 to the name of PayPal, 1,000 rupees, yen, euro, whatever currency it may be. And so now when someone wants to send money to Brazil, PayPal texts or emails or digitally messages the Brazil bank and says, please pay Joey in Brazil 50 reais. And so the bank account in Brazil's net is debited. And at the end of the week, the bank in New York or the central bank or the major bank in the middle will do one payment or as few payments as possible to net out and square out all the various balances. So the nice thing about this technology is this is really circa 2000. This became very prevalent. Well, the nice thing about it is you can have same day fund delivered. Like I can call a guy in Brazil and he can deliver your funds. But the problem is that there's a real cost of capital because I got to keep all these pools of money activated around the world, right? So that is a cost of capital. And that is why it still costs money to move around the world. Okay, so then something happened with crypto. Then what happened in around 2008, Bitcoin came out, as anyone would know, and users immediately started using Bitcoin to move money around. And I could see this very clearly when I was working at Xapo. I was the chief revenue officer of Spotify. I was a chief marketing officer of Spotify. I launched Spotify in the United States. And, it costs us, we have all these royalty payments to move back and forth between the United States and the local offices. And each time we make a payment, it would be out 3%. Like that's a lot of money. Excuse my language. I got to watch the streaming language. But, when you're giving 90% of your revenues to a studio, and therefore you're walking away with 10% of the revenues, and then you're giving 3%, 30% of that, which is 3% of your gross, to a payment company, you've just lost a third of your revenues, net revenues. So moving money, people don't think about 3%. It's killing for many businesses in the retail industry. So we noticed people moving money around using Bitcoin. But the problem about Bitcoin, it was basically instant and it was at no cost. If there are typos in here, Danny, I'll fix them. I crank this out. But anyway, but there are two problems with moving money with Bitcoin. Number one was price volatility. So I could send Danny money in Mexico City, but by the time I'd sent him $10 on using Bitcoin, which was X Satoshis, it would be $15 because Bitcoin had gone up in value or had gone down in value. So Danny was always being overpaid or underpaid, and that's a real drag. So user to third party payments was a non-happening thing with Bitcoin. It's more user to user. If I wanted to send money to my grandmother or my friend or to myself, people would use Bitcoin. So it really never scaled because the value would have fluctuations. So there's a second problem with Bitcoin, which was how to convert that Bitcoin into local cash. So basically, what would happen is let's say I got paid in the USA, I'd take the money out. Like, how do I get myself paid? So, and again, I was worried about Bitcoin because Bitcoin could go up and down in value. So this is what happened. So stablecoin appeared in 2013 and it solved the fluctuating value problem. The two problems, remember, fluctuating value, and the second problem is the off-ramp problem. Okay, so the fluctuating value problem was solved by stablecoin. Stablecoin is nothing more than a digital check. Just like an old-fashioned American Express check. When I came to college in the United States, my parents put money in an American Express office in where it was in Europe. And I came to America with a bunch of American Express checks stuffed down my pants because I was worried someone was going to mug me in 1980, 1984 when I arrived in Manhattan. And those checks are as good as money anywhere in the world, in any bank. And that is what a stablecoin is. You just put you put cash with Amex, and they give you a check that's redeemable anywhere overseas. Here we put money into a bank account. We issue the coins, and the good thing about the stablecoin, this is the big difference, is it can be transferred at the speed of light. Okay. They don't bounce. Theoretically, they don't bounce because the blockchain always checks that there's money behind them, just like the American expense checks. Not like my checks that I had at college on my local bank because I bounce those all the time, but the American Express were backed. This is the cleanest analogy. But there's one thing that stablecoin can do that you can't do with an American Express check. American Express check was for $1,000. I couldn't rip it up into 1,000 pieces and give one to Danny, one to Patrice, one to the other Danielle. It's not fungible. And the nice thing about stablecoin is that it's instant, it doesn't bounce. And if I give $1,000 to Danny, he can spread those out however he wants because they're fungible. They're breakable up into $1 pieces. Okay. Any questions
That's
from you,
an
Danny?
excellent analogy. Excellent analogy, Teymour. I remember those checks. I used to work for a very large bank in South Florida in the mid-90s. And we used to get flooded with American Express checks coming from all over Central America and the Caribbean. It was particularly popular in the Caribbean. There's one other issue with those checks is that they could only be deposited into a bank account. And
Right.
if you wanted to trade them or barter them for cash, you have to sell them at a discount, right?
Right.
And they had all kinds of security features because of counterfeiting efforts and all that stuff, but they were very liquid. I mean, they were a trusted alternative, and obviously compared to a traditional check, they not they cleared right away. The liquidity was very quick on American Express checks. So yeah, I'm with you 100% on that. One comment on your Bitcoin analogy as well, or your example of Bitcoin. The off-on ramp cost of Bitcoin today versus what it was maybe 5 years ago. Have you seen improvements, or is it pretty much that on-off ramp cost the same? And how much of it is the spread they make on the, whatever quote they give you on Bitcoin versus what you get, right? And just a regular fee that they might charge that is explicit percentage fee.
Okay, so I'm going to hold on that because that sets me up for my 2 slides from now.
Okay,
So
it's okay.
can I hold that, Danny? So
yeah, you can get back to that later. It's okay.
Okay, so to Danny's point, there are 2 problems with moving money in early crypto days. Number 1 is price volatility. Number 2 is off ramps. And so we have now solved the price volatility problem with the stablecoin. You put money in a bank, it's cash. That is $1 to $1. So now one major hurdle to global money movement has been solved. Okay. And the question is, who issues stablecoin? This is a question I get a lot. Like, what do you mean you go to a bank and put money in a bank? Well, you don't really put money in a bank. In the old days, you had to go to the American Express office. That's where you got your American. And they had these. You could actually buy traveler's checks from travel agents. Well, because they're licensed American Express, I don't know, franchisees or whatever. But this is exactly the same as what's going on today. You can go to Tether or Circle and you'll pay them cash. You can go to the website and they will credit you with stablecoin. It's that simple. And from there, from your digital wallet, you can spread the stablecoin around. Now, Tether invented stablecoin in 2013. Excuse my typo there. And it is illegal in the United States. I point that out because a lot of people ask, well, why Tether? I say Tether is really the enormous, but they've had major compliance issues with the United States, and they will launch a US-based stablecoin, they say later this year, but again, compliance issues. So really the biggest player in this space is Circle. And Circle, as many of you know, went public as a publicly traded company just last month. So having said this, I want to answer Danny's question. Okay, so now we know where stablecoin came from, who made it. We now know what it is, which is like an American Express check. And now we're going to answer Danny's. Now we know the value is locked in $1 to 1 token. Now we're going to answer Danny's question, which is like, what about the rates and the off ramps? And so this diagram, I try to show this until 2020, really, during this period, 2013 to 2020, many users would just get paid at Coinbase. So if I was living in Argentina and I didn't want to get paid in local pesos because my exchange rate sucked or whatever reasons, I would get my paycheck put into Coinbase or any exchange. And from Coinbase, I would take it out as USD coin. So my $1,000 would come in, my $100 would come in, I'd take out $100 in USD coin. But there start the problems, because who in Argentina is going to take my stable coin? So Argentina and Africa, Argentina's developed a sophisticated black market economy called cuevas, the caves, where you go with your thumb drive, you download your stable coin onto your thumb drive, and so you download it you take it in, goes to Coinbase, you take it out to your wallet, you put it in a thumb drive, 2-3 steps, and then you walk it down the road to the cueva. You give it to the dude in the cueva. He puts it in his PC. It validates the crypto, and he gives you a wad of cash and charges you, to Danny's point, 5% fee. Now, or whatever fee that is. That fee depends on the black market rates of that country, because the exchange rate is so bad in Argentina. The government exchange rate coming through banks, it's 30%. People in Argentina pay up to 10, 15% in fees to black market to take their money out. That is a big deal. So to answer your question, it's still worth it to pay 10% out when the government of Argentina is taxing you 30% to take your money out. Does that make sense? So depending on the country that you go to, you have different fee structures when you're talking about crypto out. So I'm not so much of an expert of Bitcoin anymore, Danny, but I hope I answered your question. It really depends on the government policies of the fiat that you're going to accept.
That's fair. That's fair. Good good response on that. And I guess, obviously the percentage lift on the more traditional wallet intake would probably be lower than that black market operator,
Yeah,
right?
Coinbase will take 0.5% or 1%. Like what they do, Coinbase doesn't take anything on the way in. They take 1% on the way out, 90 basis. The standard fee around the internet is 90% on the way out. So every time you take money out, it costs you money. So if you take money out to Coinbase and then you send it to an Argentine exchange, you're already out 2%, right?
Yeah.
And then you take it out to the Cueva, you're out the other, whatever. But if you put it into a thumb drive, which doesn't cost you anything, it makes it a little bit cheaper. So what we did when I was working with Patrice, who's associated with Danny on this team, we really wanted to think about getting rid of all of these middlemen steps. So here at HiGlobe, we pioneered something called the stablecoin sandwich. And our objective with the stablecoin sandwich was to make crypto totally invisible to the client. So the end client never touches crypto, doesn't even know they're moving money in and out of a wallet. And we just keep it as simple as possible. So, and this is the fundamental innovation of HiGlobe and our partners. The partners at the time were Fireblocks, the partners were Bitso, the partners were Cross River Bank. Everyone leaned in to develop this. So basically what we do is we KYC. Is this too much detail, Danny, or should I keep going with this? This is for your
No,
audience.
you're good. You're good. Maybe just kind of walk through their journey there.
So what we do is we KYC the client. Let's say Maria is sitting in Mexico and we make sure she's not a drug dealer, she's clean. And boom, we give her an account here in the United States at Cross River Bank. An account means she has her own routing number and her own account number. And that is for a clipped payments account. It is not a regular checking account. It is a flow-through account so she can get paid by people in the United States. So she gives her account to Danny Ayala, who's paying her for a I don't know what, for a consulting gig. And she gets paid in the USA. She loves that. What we do is we instantly transfer it into stablecoin, USDP, USDC. So now her balance is sitting in USDC. And from there, we can do all sorts of magic. We can give her yield, which means she gets 3%. We earn a little bit more than that. We give her 3%. She can put money on a card so she can spend locally out of the US dollar account. If she wants to go to Miami, she doesn't have to change money back from pesos into dollars. She's got a stash of dollars. She can spend directly out of it. It's a real benefit. And then we always have a local partner. In this case, it's a company called Bitso in Mexico. Bitso flashes an exchange rate. She accepts the exchange rate. And we transfer, let's say, her 100 tokens, her 100 USDC dollars from her wallet to the Bitso account. Bitso has been settled in the sky. So Bitso accepts the dollars, the stable coin, and Bitso delivers the funds from their bank in Mexico City to her bank account in Guadalajara. So its whole process is cash in, cash out, bank in, bank out. Stablecoin is only used for settlement between us and our partner in Mexico. Is that clear enough? Does that make sense? So what this does is it takes care of the second problem, which is this on-ramp, off-ramp problem. It means we have a cash-in on-ramp in the USA and we have a cash-out on-ramp in Mexico City. And our users don't have to fiddle around with tokens and wallets and cuevas, and she'll always get a great rate because we've negotiated a great rate locally for her. So two problems solved. One problem is stablecoin solves volatility, and then what's known as a stablecoin sandwich solved for the off-ramp problem which our users had.
On the one question on the when you're paying through a card, that card that you provide is that a card that you provide to the person in Mexico to spend in dollars, or is it their own card that they have in dollars?
Excellent question. We have our own card provider here in the United States. Okay. And we have to be regulated, and there's all sorts of card craziness with the Visa and like the issuing companies. So yeah, we manage that.
Okay. And then on the Bitso side, you said there's a conversion fee.
Yes, sir.
When they move from the stable coin to the local bank account that she might want the money ultimate end. So what does that run more or less? What's the range of that?
So we don't, believe it or not, we negotiate a wholesale fee with Bitso. And we say, listen, brothers, we want to have a wholesale fee. And they're like, quite rightly, they said, well, who are you? Like, what are you going to do for us? And we're like, well, we commit to $million of volume within 2-3 months. Just give us a low fee and we'll get to that volume. If it doesn't work, it doesn't cost you much, but let's scale it from there. So we negotiate a lowest fee. So we pass the wholesale price to our customers.
Yeah.
And that means our customers will always get a better deal. Now, often our customers not often, sometimes they get better deals somewhere else. We'll match it. We don't really, the objective, we'll talk about how this is monetized. The clear thesis of our company and of this individual is that prices are at zero. And we already send money to Mexico and don't charge anything, no markup, no anything. But let's hold on that. We'll get to that.
Great.
So we have two models. We have the Cueva model where the money goes out as stablecoin, and we have the sandwich model where the money goes out as fiat. And people get these obfuscated, get these confused a lot. A lot of people are like, well, stablecoin usage in Argentina, like, is this the use case? I'm like, you know what? Let's get real about it. It's only 5% of the world GDP versus 95% of the world's GDP. In other words, Argentina and Africa still have crypto out due to their massive black markets. I mean, it's a disgrace. So while the rest of the world with well-regulated economies, are moving to the stablecoin sandwich. So we believe the rest of the world is going to move to this model. I'm not too worried about Argentina. It's economically a relatively small country. And I look at Africa right now, it's a very small piece of GDP. The rest of the world is very quickly moving to the sandwich model. And this is a little dissonant with the crypto industry that says, oh, Argentina is a role model for how crypto is going to move in the 21st century. I'm like, yeah, maybe people will have crypto out in the 21st century. Of course they will. But right now, cash in, cash out is the way the model works. Daniel, does that sound appropriate? Is that too controversial? Is that okay?
No, that sounds good. Yep.
And so our philosophy as a company is, nothing's changed in 4,000 years. Nothing in money movement. Like, our users care for 4 things only: lowest cost, they care for speed, they care for secure, they care for simple. Like, you don't want to fill out 1,000 forms and make it happen. So they do not care what's under the hood, whether it's Swift, netting, or crypto mumbo jumbo. What they want is these 4 things that we list up here. Okay. So we're at 4:33 p.m. Shall I keep going on a few more slides?
I have a question, Teymour, on the off-ramp again, which is, can you do this in every country, or do you have special corridors where it happens?
That's a very good question, Daniel. We have been burned with our experience. Like, we know all the vendors in this industry. We've been burned where we dealt with a couple of vendors who've said, hey, we'll put you on 50 countries in one stablecoin wallet, and they basically got a stablecoin wallet and put it on the old WorldPay, bank network. It sucks. It doesn't work. It's not interest. They don't work on the weekends. It's not instant. It's expensive. You have double payment. You got to pay the local bank. You got to pay the man in the middle of the stablecoin. The whole thing just doesn't work. So I am sure many companies will go to a model where they have vendors that will take them to 50 countries instantly. I am thrilled for them. I'm good with them. We will not do that. We work with local exchanges, and we deeply integrate with them because we require the best rates. And these exchanges tend to have really good local banks that they've integrated with them. Does that answer your question, Daniel? So we only work in 6 corridors. We tried going out to 50, and it was deeply, deeply disappointing.
And on you mentioned the card side as well. So is the card side available in every country, or
Yes,
there are
yes.
also some restrictions?
Yeah, card is available in every country, most countries. Okay, so here's the magic of stablecoin. Stablecoin, it doesn't cost anything you go to a Circle and they'll charge you a fraction of a cent to give you 1,000 stablecoins for your $1,000 that you deposit them. Okay, it basically doesn't cost anything. So you can move those stable coins around instantly and it doesn't cost you anything. So basically what it means is the cost of moving money has gone to zero. Like, think about that. So the marginal cost. So for me, in the stablecoin sandwich, I got to pay a whole bunch of money, let's say fixed cost, to get my business up and running. But once I've got my relationship with Circle, Cross River, Bits, or anyone else in there, I'm not spending any money to send people money. So when the marginal cost when economics, when the marginal cost of providing a service goes to zero, guess what? Prices will go to zero. So here it is. When cost of moving funds goes to zero, prices will tend to zero. And we've seen this in the content industry, best illustrated by Netflix and Spotify. Do you remember when Apple used to pay 99 cents per download? Well, no longer. It's now one big subscription fee. And that subscription fee pays the content makers and the creatives behind it, right? And if you look at Netflix, there was a time when you were spending money per CD. Remember Blockbuster CDs? Well, once they could stream you the music, the videos, it collapsed to a subscription fee. That is what's going to happen to money movement. So people say, so how is money movement going to look like? Is it Amazon? Is it going to be Spotify, Netflix? My guess is that it's going to look more like Amazon. People are like, well, Amazon sells stuff. Actually, no. Amazon does not make money selling you stuff. Amazon makes money on ads. It makes money on AWS. And it makes money on Prime, which is streaming services just like Spotify and Netflix. It does not make its profits on, it doesn't lose money, but it doesn't look to massively monetize the clothes that it sells to you and the stuff that it sells to you. So this is really instructive. This is what the future of money movement, in our humble opinion, not my company and HiGlobe's humble opinion, looks like. So we at HiGlobe make money in non-traditional ways. So we offer our users a USD account. Our competitors do that. Instant, our competitors don't do that. And lowest cost guaranteed. Our customers don't do that. So we don't make money on any of this. We don't lose money, but so the way we make money is we make money on yield, the money my users leave with me overnight. I make money on the cards that they use to spend. I make money on exchange rate optimization tools, which I'm building. And sooner or later, we're going to do a subscription fee, which will bundle a whole bunch of these services and give our users a better rate. So we're building this company so it looks more like Amazon. So we have all these value-added services that we can add. And again, here's a picture of one of our clients. Is why? Because we believe there'll be huge margin compression in traditional fees. We already see it happening. And the mission of our company at HiGlobe is, to this end, we will move the world's money instantly and at no cost. This is our mission. And we are already moving it instantly at no cost to Mexico, which is, we had slightly marked up in Brazil, but in Mexico, it's zero cost. So in all of this, who will be the winners and losers? I sort of cranked out the last 3 slides because I was running out of time. So the winners, we believe the winners are those people who don't make money on moving money. So if you look at the B2B side, it's going to be people like Circle. Circle makes money on yield. They issue stablecoin. Tether is going to be a winner. Circle is going to be a winner. Stripe just bought Bridge. I should do a whole bunch more slides on this. I can do a better presentation. They make money on merchant payments. I don't think they will be making money on moving money. They are very happy to provide that free of charge. And they will integrate vertically. You already see that. Stripe has bought Bridge. Bridge bought a wallet provider. Circle has bought a wallet provider, has got a banking license, and Circle is also making moves to get a liquidity provider in Brazil, all the way through. And in terms of end users, which is our market, we can say, well, Teymour, what about you? How come you're not going to get put out of business? Well, I might be put out of business. I'm very clear-eyed about this. The people I fear are people like Nubank, massive bank in Brazil. They offer loans, car loans, homes, everything. They'll provide money services, movement services free of charge. Same with Revolut. Revolut is a massive European company. They don't need to make money on moving money. Robinhood in the United States, it's going to be a super app. They'll also chances are be offering these services. So again, this is a little flavor of some of the changes and disruptions that will come in this market. So I've got two more slides. I don't know if there are any questions lining up or any, but
Yeah, there's two questions. One from the audience and another one from my truly. But I'll ask Patrice's question. Actually, he's just posted it on the feed on LinkedIn. His question is, what do you expect the 800-pound gorillas like MoneyGram and Western Union to do or not do with stablecoins?
so I think we've seen this before, and my prediction, and I'm willing to bet lunch on this. This is what's going to happen. They're going to make a lot of money for the next 2 years, 3 years. MoneyGram's already there because they don't have to reduce their prices. So what happens is that the technology moves more quickly than the business models. So MoneyGram is minting money. It went private, I believe. I can't remember what they're doing, but they already been playing with Ripple, and they're already moving to stablecoins. So they will keep making that 2 or 3% on their users, but they're paying nothing in terms of moving money. So they're going to do what happened with Apple. Apple was charging us 99 cents for 10 years, 2005 to 2015, running digital rails, and it just minted money until it was losing such market share to Spotify that it had to go to the subscription model. So basically what will happen is MoneyGram, I believe, is going to mint money. MoneyGram will mint money until it starts really feeling competition from the new media. From someone like us, I think it's going to be a company like Felix Pago that'll put the kibosh on them, because Felix Pago is very competitive and they run on stablecoin, and they're growing massively. And same with Western Union. I think Western Union is going to move to the new rails. Their stock's going to go up. They're going to do really well. Why? Because they have all this working capital tied up in pre-funding accounts. Remember all those little pots of money? All those pots of money are going to get liquidated. So there's more money for Western Union. They're going to make a lot of money in the next 2, 3, 4 years. And then boom, there'll be a day of reckoning when they've lost so much market share to someone like Felix Pago. And that's kind of what I feel might happen. Does that answer the question, Danny? I don't know if it's a great answer, but it is what I got.
Oh, that's an adequate answer. Thank you. Appreciate it. I'll ask my question at the end of the session. I'll let you continue your slides.
Okay. So I got a question, like buzzword bingo questions, which is, what is programmable money, right? And I always point out to this analogy, which is, do you guys remember when the US government paid out your COVID relief? You got a little debit card in the mail with some people got checks if you had a banking. Actually, everyone on this call will have got a check. But the unbanked got a debit card. And the debit card, when the unbanked person went to the bodega to get his food or whatever he would get with that debit card, the bodeguero was charged 3 to 5% by Amex and Visa, and probably in the year of 5 or even up to 6%. What people don't realize is the smaller the bodega, the worse the neighborhood, the higher fee you get, and the worse terms you get. So you probably get paid a week later. Okay. So I took a picture here of a bodega because I like cats. I thought we'd have a bodega cat in there. And that is the current state of technology. So what's programmable money? Stablecoins are programmable. What does that mean? It means that in the immediate future, Walmart will send a user funds into their wallet, into their cell phone, that can only be paid, or it's like a coupon, digital coupon, that can only be paid at a certain location because the cell phone will have geo-fenced those tokens, that they can only be paid between 12 and 3 p.m. So it's time fenced. It's not geo-fenced, only geo-fenced, but time fenced. But that only the owner of that cell phone can use. It's not like my debit card that I can give to somebody else, right? And I can spend on crack or whatever else I want to spend. But if that, and most importantly, it'll be linked to a QR code, it can only be used for dry powdered milk, because the QR code, it'll only be redeemable when it's a QR code of a certain type. So basically, you're going to have instant disappearing money that comes and goes in your wallet given to you by retailers. So if there was this flash sale going on at Barney's, and Barney's out of, local store right here, they'll send you money. Hey, we got 3 seats at the local restaurant, 3 seats open for lunch today. Come over, we'll give you a free drink. Boom. It'll come 2 hours later, the money will disappear from your wallet because you haven't spent it. So we're moving to a world where you have digital money that's programmable. So let's demystify it. And now you know that stablecoin can be used to move money across the world as a way of settlement. And stablecoin can be used as a way to provide offers that are highly targeted to individuals in local communities. Okay, that's basically it. HiGlobe.com is the name of the company, and this is my email if anyone wants to reach out to me. That's the presentation.
Thank you, Teymour. Outstanding overview. We really appreciate it. So I have a question for you. Just if you could confirm or otherwise correct what I'm thinking and what I'm assuming based on what you shared. But basically, the payor. I mean, I worked at large banks for about 30 years. Some might say regrettably so, until I discovered fintech. And no pun on the banks. Banks are actually okay, but things have changed. One of the biggest concerns, and there was an article on Wire magazine published yesterday, which I actually shared on my LinkedIn feed with people. They're basically saying that all these incentives / interest / rewards that the stablecoin issuers are going to be granting directly to wallet holders that agree to maintain balances with them are a big challenge for the banks, and potentially that's the reason why many of the banks are jumping on the bandwagon of stable coins, trying to issue their own stable coins. I don't know about you, but for the last for my lifetime, I've been lucky to see a few pennies jump into my checking account for the balances I keep if they pay me any interest, right? So I think there's a big gain here for consumers, but there's a balance here, right? I mean, the custody of the funds is a question mark in some risk mindset perspective, and also there is the benefit to the consumer who's actually going to get rewarded, right? So any thoughts on that?
So the Genius Act makes it illegal for a non-bank entity to issue interest. And that's so basically yield. So Circle will never pay me interest. So the stablecoin is really set up as a payment mechanism, as a settlement mechanism. It's not really regulated. I think it's whichever side of the political spectrum you sit on, the legislation is pretty good in that it basically says stablecoins meant to be to facilitate payments as tokens. I'll give you 1 token, 3 tokens, and you give me the good and whatever. The token has to be backed. So I get it. On the other hand, there are some loopholes in there that the industry is trying to close. But here's the point. I think it's a struggle between traditional banks that earn interest, because any bank can offer yield, can pay interest. Remember that, and any bank can issue stablecoin. So if you're a traditional bank, what do you want to do? Do you want to spend money on lawyers to keep yourself the yield to yourself, or would you want to put in a new expense and put in new stablecoin infrastructure? I mean, all I'm trying to say is that there is a struggle between traditional banks and, let's say, Circle, who is now going to become a traditional bank by getting its bank charter. But yes, Danny, you raise a very good point. Only banks can pay interest, and nobody's allowed to pay interest on stablecoins, because in the United States, because it is considered a form of settlement, it is not considered money. It's like a check. A check is a digital check. That's what it is. So there is some conflict around that, but it doesn't really affect me that much.
Thank you for that. The second question I have, and Daniel, feel free to ask a question after this as well. I don't see any more questions coming in from the audience, but I see 2 benefits here for the payor, the company issuing payments. Some companies are issuing thousands of payments. Think about the insurance industry, how many payments they have to issue when there's a disaster or a hurricane or whatever it might be, a fire.
Day to day, every day, every day.
Exactly. So when they issue these payments, there's a cost associated with that, right? I mean, an ACH payment, depending on the provider you find, could cost you, anywhere from 20 cents to 50 cents per ACH. If you're sending
That's right.
wires, it's going to cost you even more. And all of those have a lag, right? I mean, unless you do use same day ACH, you're looking at T+1 or T+2. And there's a cost in time and there's a cost in speed associated with that. Stable coins, that goes away, cost element goes away. So from a payer perspective, all the incentives to use stablecoin are there. From a payee perspective, the biggest bang for the money is to be able to stay in stablecoin, pay and process whatever you need to pay and process in stablecoins, and that way you avoid any exchange fees or any real exchange costs. And to some extent, I think the shift to a completely digital movement of money, movement and payments, it's going to evolve very quickly with that incentive.
Danny,
Am I getting
totally
that
agree.
wrong? Does that make sense?
That totally makes sense. So, two really important points that you touch on. So I made the argument early on that you have two worlds, Africa and Argentina, that crypto out, and then you have the 95% of the world GDP that is cash out. That's because they have very well-run government. They have well-run governments. I think what's going to happen in the other 95% over time, you may end up changing into a Brazilian stablecoin, or small countries like Salvador, Guatemala, they're already dollarized. Venezuela, they're already dollarized. You just use a dollar everything becomes dollarized. Larger economies like Brazil are not going to tolerate that. Colombia is not going to tolerate that. So what will happen is you'll have local stable coins, but again, one-to-one transfer, real smooth, and but the money will be digital in process. That's the first point. The second, so yes, we will move to a stablecoin centric world, I believe, in various leaps depending on local regulation. I will point out something else, though. You and I, we know that we can't give yield. We can't take yield from Circle on my stablecoin. I can put my stablecoin on a marketplace like Aave or Tesseract or Signum Bank. There's a whole bunch of people you can put them with, and they will pay you. They put your money in treasuries, and they will pay you yield on your stablecoin. So you can be someone living in Guatemala, and you can get paid in dollars, and you can put your money in yield. We do that, as you see already at HiGlobe. We give you your interest, and you can settle locally whenever you want as well. So we are moving to a dollarized world in the smaller economies, and we're moving to maybe a stable coin friendly place in the large economies. Like China has now opened discussions on stablecoin. So is India, and Brazil is way ahead. They've already approved stablecoin issuance in BRL.
Thank you.
So I have another question. You remember I think it was 2012, Walmart, Home Depot, Target, all the big merchants in the US started MCX, which was a competitor to Visa, to be able to say, look, we're going to manage our own payment system so we don't pay these fees and so on. I remember organizing a meeting with Carrefour and Total in New York around that time to see if this initiative of MCX could make sense in Europe. Reaction of Carrefour at the time was to say, look, we pay so little in Europe that it doesn't make sense. And by the way, you will see all the costs associated with managing a payment network. Now, we're 13 years later, and the technology has evolved. We have stable coins. So now what do you think? Does it make sense for a Walmart, Target, and so on to become an issuer of stablecoin? Or is it better for them to use Circle or other issuers that will happen?
Oh, you ask like a futuristic question that's beyond my pay grade. I do not know. Like, do we see a world? I do see someone like Walmart buying a bank. They can afford to. or getting a bank license. One of the community banks is complaining right now. They issue a stable coin for $1 billion or $1 billion, and they earn interest on it because they keep the interest on it, and then they can do all sorts of funny magic to your wallet or not to your wallet. Maybe that's one scenario. The other scenario is they will work with Circle. I do not know. I do think it's a brave new world. It's like the beginning of the internet. Everyone of the consumer internet is going to be a bit of a wild, wild west. I believe retail is particularly going to be up for challenge, and for lots of disruption and change. I think money transfer globally overseas, which is what I do, I think that's easier because it costs me too much money to run a bank, to buy a bank or have a bank. Like I need to focus on my customers and give them the value added so they subscribe to my service. So my hunch on this is that I will not be like in the global money. Maybe MoneyGram will, or maybe I don't know what, Western Union will buy a bank and they'll make a buttload of money. I don't know, but I think a lot of the smaller, like there are 4,000 community banks in the United States. I think a lot of them are going to get snapped up because there's a lot of value to be unlocked by, let's say, 20, 30 big players. It's all going to be the same old dollar. It's all exchangeable. It's just issued by various consortia. So we are going into a little bit of a Wild West period. It's going to be interesting.
Yeah, thank you. And another question, which is you have different use cases for stablecoins. Where do you see the biggest volume? Is it a B2B? Is it a B2C? What is it? Or even trading, crypto to crypto?
So again, you need to ask the gentleman at Circle about that because there's a massive amount of volume for stablecoin trading to settle. People buy stocks and they want to trade in stablecoin. You have big players. In fact, NASDAQ is moving that way. The whole world is moving that way. In terms of global money movement, the numbers are still pretty small. Daniel, I think the numbers are really fractional, but they're going to grow real quick next year. It's going to change totally next year. I think the retail case with Walmart and that we talked about at length just now, I think that's going to be a little bit later because I think there's going to be some lawyering in there, some sharp elbows in there. To your point, maybe consortia appear. So yes, use cases. The use case that users do not see is the day-to-day transactions, because even in Argentina, the day-to-day people take their money and they get pesos as a wad of cash. There's a lot of frustration among the crypto digerati that people are not using stablecoin to transact and buy their meal and buy their dinner and buy their gasoline for. Even in Africa, people pay using cash because the governments manage that whole ecosystem. So there's a lot of frustration that there isn't, oh, we don't have more use cases for stablecoin. I'm like, hold on, it's huge for trading. It's huge. It's huge in growing a money movement. It'll be huge in retail. It'll grow massively. And you're also going to see a massive usage of stablecoin to settle between AI and automated payments. So you're going to have automated payments for AI engineering work because it's just done instantly. And so, yes, we have use cases. It's not quite the use case that some utopians have initially hoped for.
Thank you, Teymour. Appreciate that. Brave new world coming in the future. There is that other acronym called CBDCs.
That's right.
And there's a perspective that some might say that once we outgrow stable coins, potentially CBDCs may be unavoidable. There's a lot of mixed feelings about it. Some countries are exploring them and implementing them, while others are banning them because it basically centralizes control even more than physical money today and potentially eliminates the privacy element that some people enjoy about fiat money and even to some extent stable coins, right? So any perspective on that as the last final closing comment, and then we'll wrap up.
What a great question. CBDCs. So you'll see that I did the historical analogy. People immediately understand it when we talk about American Express checks. It's like, I get it. It's a very clear image. So my question is it the role of government to be, so when I go to my bank and I buy checkbooks, those checkbooks are printed by a third-party check printer, right? My question is it the government's role to be a check printer and selling checkbooks to people? Because that's what Circle is. That's what Tether is. They're selling a digital checkbook. The reason why they're so big is that right now they have concentrated in 2 or 3 major players. 5 years from now, there may be a dozen players, 30, 50, 100 players. I don't know. But right now, my question is the government in the business of issuing checks? Number one. Second question I'm going to ask about CBDCs is that the government can turn off your money in your wallet. And that is very scary. And the government can look at where I go on the web. If I go to like a porno site or I go to pay to, like if I'm a smoker, they can see all of that. And so there are real privacy issues with the CBDC, which you know, but I am going to make a clear analogy. History likes to look back upon history. What do I mean by that? Is we like to look for priors. The whole legal system is built on legal precedent. So what's the precedent for the stablecoin? It's very simple. It's the credit bureaus. We already have a precedent. So right now, 90% of my money is managed by a company called Visa, handled by a company called Visa. That my credit card company. But why do so cash used to be private. You used to have cash. No one used to know what I'd spend. Well, in the world of the digital world, now I've got Visa looking at all my transactions. For the government to get access to my transactions, they got to call Visa and say, here's a judge's warrant for Teymour's transactions. And that gives me some degree of privacy and makes me feel good. Though I can't stand Visa for selling my name to every telemarketer and every spam operator, whatever. The one people they won't give my information to is the government without a judge's warrant. So that's exactly the same with stablecoin. The government can turn off your money with a CBDC, can glitch your money. Imagine calling government 800 number. Hey, my money's turned off my wallet. I'm dying. Like, who's going to pick up the phone? Okay. Well, you can do that with Circle. Like they have competitive companies. And this is the point, is that if the government wants to access my records with a stable coin, all they need to do is get a judge's warrant, go to the stablecoin company, just like the credit card company, get a writ, and you know what? They get access to my data. But there is a line, there's a company like a bulldog called Circle that will fight for my information privacy versus the government. So I believe that's a good model. CBDCs may come in the future. I will make 2 predictions. You'll never have the diversity of features on a CBDC that you'll have on stablecoin. You're gonna have stablecoins for payments, for discounts, for I don't know what, for like school, I don't know, whatever it is, vouchers. You're gonna have so the private sector is gonna develop the payment form, number one, much better than CBDCs. Number 2, our privacy is gonna be managed much better on stablecoin, not on CBDCs. So I tend to feel that the future is going to be a stablecoin future. And CBDCs are preferred by authoritarian states. People say, well, so why did Trump ban CBDCs in the United States? And there's a very good reason why. Is because if you have one CBDC, it'll crowd out all the stablecoins. Why? Because in the US, people will want to use the CBDC because it's backed by the government. There won't be any issues, despite the fact that they can look at my personal information. So CBDC in many ways has certain advantages, but my money is on stablecoins. I believe we have a stablecoin future ahead of us in the digital future.
great perspective, Teymour. And that really concludes our talk today. We really appreciate it. I think the LinkedIn streaming has cut us off already, but this will be live in our YouTube channel. First of all, thank you so much for your excellent presentation as well as your generous time today. We appreciate it. And for those of you who are watching the YouTube channel, you can find us at LinkedIn at ConexAmericas. There's our contact information for any additional information. And we thank our sponsors, Pay Academy and 999 Global Ventures, Daniel's company and my company, for sponsoring this. And thank you, Teymour, for the time once again. And we look forward to seeing you on the road of stablecoins forward. Continue your success and your amazing trail that you are leaving behind, and continue to open the roads of innovation and technology. Thank you.
Thank you all. Thank you, Danielle. Thank you, Danny and Patrice. And appreciate this opportunity.
Thank you very
Cheers.
much, Teymour.
Thanks. Bye.
Thank you. Bye.